What if I told you the most powerful lessons in trading in the zone aren't the ones everyone talks about? In fact, hidden inside this book are 8 psychological lessons that most traders read, but almost nobody truly understands. And once you understand these 8 lessons, you'll never look at winning, losing, risk, or even the market the same way again. So stay with me until the very end, because each lesson builds on the last, and the final one might completely change the way you trade forever. Friends, let's start with the first lesson. This is the lesson that can completely change the way you think about trading forever. Most traders believe they're losing money because of bad entries, bad indicators, or bad strategies. But Mark Douglas points to something much deeper. He suggests that the biggest enemy of a trader is not the market, it's the mind they bring into the market. Think about this for a second. Have you ever entered a trade, watched it move a little against you, panicked, closed it, and then watched the market move exactly where you originally expected? The market didn't force you to exit. Your mind did. Now imagine another trader looking at the exact same chart, same candle, same price, same information, yet one trader buys confidently while another sells in fear. How is that possible? Because neither trader is reacting to the market. They're reacting to the meaning their brain has attached to the market. This is where almost everyone misunderstands trading psychology. The chart doesn't create fear. The chart doesn't create greed. The chart doesn't create panic. Your memories do. Every loss you've ever experienced, every trade that hurt your confidence, every time you hesitated, every time you were wrong, your brain stores those emotional experiences like invisible software running in the background. And the next time a similar situation appears, your brain isn't seeing today's market, it's replaying yesterday's pain. That's why 2 traders can watch the exact same setup and make completely opposite decisions. One sees opportunity, the other sees danger. Not because the market changed, but because their internal beliefs are completely different. Here's something most people never realize. The market is actually neutral. It isn't trying to reward you. It isn't trying to punish you. It doesn't know your stop loss. It doesn't know your account balance. It doesn't even know you exist. Yet traders constantly speak as if the market is attacking them. The market hunted my stop. The market trapped me. The market wanted my money. No, the market simply moved. The story was created inside your own mind, and the moment you understand this, everything changes, because now you stop trying to control the market, and you start learning to control your perception. Professional traders understand something that beginners rarely accept. Every single candle is simply information, nothing more, nothing less. It doesn't contain fear, it doesn't contain hope, it doesn't contain certainty. Those emotions only appear after your mind interprets what you're seeing. That's why emotional control isn't about becoming fearless. It's about refusing to let old memories make today's decisions. Imagine a professional poker player. He loses one hand. Does he assume the next hand will also lose? Of course not, because every hand is independent. Professional traders think exactly the same way, but beginners don't. After one losing trade, they hesitate. After 2 losses, they reduce position size. After one big win, they become overconfident. Notice what's happening. They're no longer trading the market. They're trading their last experience. And that's where consistency disappears. Here's a question that almost nobody asks themselves. If you removed all memories of your previous trades, would you still make the same decision today? If the answer is no, then your past is controlling your future. That's not trading. That's emotional programming. The truly profitable trader doesn't have better predictions. He has cleaner perception. He looks at probability, not certainty. He understands that every trade is simply one event inside thousands of future trades, nothing more, nothing less. And because of that, he doesn't need this trade to prove he's right. He only needs to execute his edge correctly. This is one of the deepest psychological shifts in trading. You stop asking, "What if I'm wrong?" And you begin asking, "Did I follow my process?" Because being wrong on one trade means absolutely nothing. Breaking your process means everything. The market cannot damage your confidence. Only your interpretation can, once you realize that you stop blaming the chart, you stop blaming institutions, you stop blaming market makers, and for the first time, you begin taking responsibility for the only thing you can actually control, your own mind. That single realization changes the game forever. But here's the shocking part. Even if you completely master this lesson, you can still lose consistently. Why? Because there's another psychological trap hiding underneath this one. A trap so powerful that it silently controls almost every retail trader without them ever noticing it. And that's exactly what we'll uncover in Lesson 2. If the first lesson taught us that the market doesn't control your emotions, then this second lesson reveals something even more uncomfortable. Most traders think they're in the market to make money, but deep down, that's not what they're really chasing. They're chasing something much more dangerous. They're chasing the feeling of being right. Think about it. Why does a trader refuse to close a losing position, even after all the evidence says the trade is invalid? Why do people move their stop loss farther away? Why do they keep averaging down? Why do they hold a losing trade for days, but close a winning trade in just a few minutes? The answer isn't strategy, it's psychology. Because closing a losing trade doesn't just feel like losing money, it feels like admitting, I was wrong. And for the human brain, that hurts far more than the financial loss itself. This is where ego quietly enters trading. The moment you place a trade, most people stop seeing it as a position. They start seeing it as a reflection of themselves. If the trade wins, I was smart. If the trade loses, I failed. Can you see the problem? A single trade suddenly becomes connected to your identity, and once that happens, logic disappears. Now your brain isn't trying to protect your account, it's trying to protect your self-image. That's why intelligent people sometimes make the most irrational trading decisions, not because they don't know what to do, but because their ego won't let them do it. Imagine a doctor. If one treatment doesn't work, does the doctor refuse to change the diagnosis just to avoid being wrong? Of course not. The doctor changes the plan because the goal is helping the patient, not protecting the doctor's ego. Professional traders think the same way. Their goal isn't to prove they're right. Their goal is to make money over hundreds of trades. Retail traders often reverse that. They'd rather be right on one trade, even if it costs them their account. That's why you'll hear statements like, I'll wait, it'll come back. I know I'm right. The market is wrong. Listen carefully to those words. Every one of them is driven by certainty, not probability, and certainty is one of the most expensive emotions in trading. The market doesn't reward confidence, it rewards discipline. A professional trader has no emotional attachment to a position. If the market proves the trade invalid, he exits. Not because he's weak, but because he's flexible. He understands something most people never learn. Being wrong is part of the business. Staying wrong is a choice. Read that again. Being wrong is part of trading. Staying wrong is a decision. Every successful trader has losing trades. The difference is, professionals pay small losses quickly. Amateurs borrow bigger losses from the future. Now ask yourself one question. When your stop loss gets hit, what's your first thought? Is it, what's my next high probability setup? Or is it, I have to win this money back immediately? That single answer reveals whether you're trading with discipline or with ego. Because revenge trading is never about money, it's about repairing your pride. Your account didn't get hurt, your identity did, and your brain wants revenge. But the market has no idea you're upset. It simply keeps moving. This is why so many traders lose twice. First, they lose money, then they lose control, and the second loss is usually much bigger than the first. The strange truth is this: the traders who make the most money are often the people who care the least about being right on any single trade. They know that one trade means nothing, 10 trades mean little, 100 trades begin to reveal the truth. Consistency is never built on one prediction, it's built on repeated execution. That's why professional traders don't celebrate every win and they don't panic after every loss. Both are simply data, nothing more, nothing less. The moment you stop needing the market to validate your intelligence, you become emotionally free, and emotional freedom is where consistency begins. But here's where things become even more fascinating. Let's imagine you've mastered your emotions, you've accepted losses, you've stopped chasing the need to be right, you execute your strategy perfectly. You'd think that would be enough to become consistently profitable, right? Wrong. Because there's one final invisible trap that quietly destroys even disciplined traders. It's so subtle, most people don't even realize it's happening. And once you understand it, you'll never look at confidence, winning streaks, or success the same way again. That's exactly what we'll uncover in Lesson 3. By now, you've learned something most traders never truly understand. The market doesn't control your emotions, and your biggest addiction isn't making money, it's being right. But now we're about to uncover a lesson that surprises almost everyone. Most people believe fear is the biggest enemy in trading. They spend years trying to eliminate fear. They read books, they meditate, they practice discipline, because they think, if I can stop being afraid, I'll finally become a profitable trader. But what if fear isn't the most dangerous emotion at all? What if the real danger is something that feels incredibly good? Something that makes you feel powerful, confident, almost unstoppable? That emotion is certainty. Think about the biggest trading mistakes you've ever made. Was it when you were careful? Was it when you were following your rules? Or was it when you thought, this trade can't fail? I'm 100% sure. This setup always works. Most account-blowing losses don't happen because traders are afraid. They happen because traders become convinced they're right. And certainty changes your behavior without you even noticing. The moment you feel certain, you stop asking questions, you stop respecting risk, you stop preparing for the unexpected, you begin acting as if the future has already been decided. But the market never promised certainty. It only offers probabilities. That's one of the hardest truths to accept. Even the best trading setup in the world can lose. Even the strongest trend can reverse. Even the smartest trader can be wrong. Not because they're unskilled, but because uncertainty is built into the market itself. Professional traders understand this deeply. That's why they never bet their identity on one trade. They don't expect certainty, they expect possibility, and because of that, they're always prepared for both outcomes. Imagine a pilot preparing for a flight. Before takeoff, the pilot doesn't assume nothing will go wrong. Instead, he prepares for everything that could go wrong. Not because he's negative, but because he's professional. Trading works the same way. Professionals don't enter a trade expecting perfection. They enter with a plan for success and a plan for failure. Retail traders usually prepare for only one outcome, winning. That's why losses feel like personal attacks, because they never emotionally accepted that losing was part of the plan. Here's where certainty becomes truly dangerous. After 3 or 4 winning trades, your brain starts creating a story. I've figured it out. I finally understand the market. This time is different. And without realizing it, you increase your position size, you skip your checklist, you ignore warning signs, you move your stop loss, you take trades outside your system. Why? Because certainty whispers something extremely convincing. You don't need the rules anymore. That's exactly how discipline slowly disappears, not in one dramatic moment, but through tiny decisions fueled by overconfidence. Ironically, the traders who survive the longest are often the ones who remain humble, not because they lack confidence, but because they respect uncertainty. They know the market owes them nothing. Every morning they begin with the same mindset. Today, anything can happen. That single sentence protects them from emotional blindness. There's another hidden danger of certainty. It makes you stop learning. Once you believe you've mastered the market, you stop reviewing your mistakes, you stop improving your process, you stop questioning your assumptions. Growth ends the moment certainty begins. The best traders in the world never act like they know everything. They stay curious, they stay adaptable, they stay flexible, because they understand something most beginners never realize. Confidence comes from following your process. Certainty comes from believing you can predict the future. Those are completely different things. Healthy confidence says, I'll execute my edge no matter what happens. Dangerous certainty says, I already know what's going to happen. One creates consistency, the other creates disaster. This is why Mark Douglas emphasized thinking in probabilities instead of predictions. A probability mindset keeps your ego out of the trade. It reminds you that no single outcome defines your ability. You're simply executing an edge over a large sample of trades, nothing more, nothing less. Once you truly accept uncertainty, something unexpected happens. You actually become calmer because you stop demanding impossible guarantees from the market. You no longer need every trade to win, you only need to follow your plan, and that's where real confidence is born, not from winning, but from trusting yourself to execute consistently. Now here's the twist. Let's say you've accepted uncertainty, you've stopped chasing certainty, you've learned to think in probabilities. Most people would assume you've finally reached the mindset of a professional trader, but there's still one invisible habit that quietly destroys consistency, even when your psychology is strong. It's a habit almost every retail trader repeats every single day without realizing it. And once you recognize it, you'll understand why so many traders with great strategies still fail. That's exactly what we'll uncover in Lesson 4. So far, we've uncovered 3 powerful truths. The market doesn't control your emotions. Your biggest addiction is being right, and certainty is often more dangerous than fear. Now let's explore the lesson that quietly connects all of them together. This lesson is simple to understand, but incredibly difficult to live by. Every trade is completely independent of the last one. At first, that sounds obvious. Of course, every trade is different candles, different buyers and sellers, different market conditions. But here's the problem. Your brain doesn't treat them as independent events. Instead, it links every new trade to your previous experience. Imagine you just lost 3 trades in a row. A perfect setup appears. According to your trading plan, you should take it, but your hand hesitates. A voice inside your head whispers, "What if this one loses too?" Notice what's happening. The current trade hasn't done anything yet, but your mind has already judged it based on the last 3 losses. Now imagine the opposite. You win 5 trades in a row. Another setup appears. This time your mind says, "I'm on fire, let's increase the position size." Again, the new trade has done nothing, yet you're treating it differently because of what happened before. This is one of the biggest psychological traps in trading. You're no longer trading the setup in front of you, you're trading your recent memories. Professional traders understand something that beginners rarely accept. A winning streak doesn't increase the probability of the next trade. A losing streak doesn't decrease it either. Each valid setup deserves to be judged on its own merits, nothing else. Think of flipping a fair coin. If it lands on heads 5 times in a row, does that guarantee tails next? No. The next flip is still independent. Trading works in a similar way. Your edge plays out over a large sample of trades. Not over the last 3, not over the last 5. Over hundreds of disciplined executions. That's why professionals don't become emotional after a streak. They stay focused on one question: did I execute my process correctly? Not, did I win, because winning and executing correctly are not always the same thing. You can follow every rule perfectly and still lose. You can break every rule and still win. But only one of those behaviors leads to long-term success. The market sometimes rewards bad habits, and that's dangerous, because one lucky trade can convince you that discipline isn't necessary. Over time, that false confidence becomes expensive. The professional trader never lets one outcome change the process. He knows consistency is built from repetition, not emotion. He treats every trade like the first trade of his career. No baggage, no excitement, no fear, just execution. Here's a powerful question to ask yourself before every entry. If I had no memory of my last trade, would I still take this setup? If the answer is yes, take it. If the answer is no, your emotions, not your strategy, are making the decision. That single question can completely transform the way you trade. Because the goal isn't to predict the next trade. The goal is to become the kind of trader who executes the same way, regardless of what happened 5 minutes ago. That's real consistency. And once you reach that point, the market stops feeling like an emotional roller coaster. It simply becomes a place where probabilities play out over time. That's the mindset Mark Douglas wanted every trader to develop. Not the mindset of someone trying to be right, but the mindset of someone willing to trust the process. And once you truly understand that, you're no longer thinking like a retail trader. You're beginning to think like a professional. We've reached the fifth lesson, and this might be the lesson that changes the way you look at trading forever. Most traders spend years searching for the perfect strategy. They jump from one indicator to another, one mentor to another, one system to another. They believe that somewhere out there, a holy grail strategy exists, a strategy that almost never loses. But here's the uncomfortable truth. The problem isn't that traders don't have an edge. The problem is that they never give one edge enough time to work. Think about it. A trader finds a strategy, it wins twice, then loses 3 times. Immediately he starts doubting it. He changes the indicators, changes the time frame, changes the entry rules. Sometimes he abandons the entire system. A week later, he repeats the exact same cycle with another strategy. Months pass, years pass, nothing changes. Not because every strategy failed, but because the trader never stayed consistent long enough to discover whether it actually worked. Now imagine a casino. Every single day, thousands of people walk into a casino and win money. Some leave with huge jackpots, some double their money in just a few minutes. If you walked into the casino and looked only at those winners, you might think the casino was losing, but the casino never panics. It never changes its business model because a few people got lucky. Why? Because the casino doesn't focus on one outcome. It focuses on thousands of outcomes. It knows that over time, its statistical edge will eventually show itself. Professional traders think exactly the same way. They don't expect every trade to make money. They expect their edge to make money over a large sample of trades. That's a completely different mindset. Most retail traders judge their strategy after 3 or 4 trades. Professionals judge their execution after 100. That's why professionals stay calm while beginners become emotional. Their confidence isn't built on recent results, it's built on long-term probabilities. Here's another mistake that destroys consistency. Many traders create rules, but they don't actually follow them. They say, "I'll always use a stop loss," until one trade starts moving against them. Then suddenly, they move the stop. They say, "I'll risk only 1% per trade," until they become convinced this setup is different. Then they risk 5%, little by little. Discipline disappears, and once discipline disappears, the edge disappears with it, because an edge only works when it's executed consistently. Imagine giving 2 people the exact same profitable trading strategy. One follows every rule for an entire year. The other changes the rules every week based on emotions. Who do you think has the better chance of succeeding? The strategy is identical. The difference is execution. That's why consistency is more valuable than intelligence, more valuable than prediction, even more valuable than confidence. Because consistency allows probability to do its job. Without consistency, probability never gets the opportunity to work. This is why Mark Douglas believed that successful trading is less about finding the perfect setup and more about becoming the kind of person who can execute a simple setup over and over again without emotional interference. That's much harder than it sounds, because human beings naturally want certainty. They want immediate proof. They want every trade to validate them. But the market doesn't work that way. It rewards patience, it rewards discipline, it rewards consistency. The strange part is, many traders already know exactly what they should do. They know where to enter, they know where to exit, they know how much to risk. The missing piece isn't knowledge, it's the ability to repeat the same good behavior when emotions become intense. That's why trading is often described as a performance profession. Just like an athlete doesn't win because he knows the rules of the game, a trader doesn't become profitable because he understands charts. He becomes profitable because he performs correctly under pressure, and that's a completely different skill. So before you search for another indicator, before you buy another expensive course, ask yourself one honest question. Am I looking for a better strategy, or am I avoiding becoming a better trader? Because once you master consistency, your edge finally gets the chance to prove itself, and that's the moment trading stops feeling like gambling and starts becoming a professional business. This lesson brings us to the heart of Mark Douglas's philosophy. The market was never your biggest challenge, you were. And the moment you master yourself, you'll discover that consistent profits were never hidden inside the charts. They were hidden inside your mindset all along. We've already discovered that consistency is more valuable than the perfect strategy. Now let's uncover another truth that surprises almost every trader. Most people believe the smartest traders make the most money. It sounds logical. If someone has a higher IQ, understands economics, reads every financial report, and can analyze charts perfectly, they should naturally become a successful trader. But that's not what happens. In fact, some of the most intelligent people lose fortunes in the market. Why? Because the market isn't an exam, it's an environment of uncertainty. And uncertainty doesn't care how intelligent you are, it only cares how disciplined you are. Think about professional athletes. Knowing how to swing a golf club doesn't make someone a champion. Knowing how to shoot a basketball doesn't make someone an NBA star. The difference is execution under pressure. Trading is exactly the same. Almost every trader knows they should cut losses quickly. Almost every trader knows they shouldn't overtrade. Almost every trader knows they shouldn't risk too much on one position. The knowledge is already there. The real question is, can you still follow those rules when fear and greed take control? That's where discipline separates professionals from everyone else. Discipline means following your plan, especially when your emotions beg you not to. Anyone can follow rules after a winning trade. Real discipline appears after 3 losses in a row, after missing a big move, after watching someone else make money while you're sitting on the sidelines. Those are the moments that reveal who you really are as a trader. Here's another mistake that destroys countless accounts. Many traders believe discipline is something they use only after entering a trade, but discipline actually begins long before that. It begins when you decide not to take a low-quality setup. Sometimes the highest-paying trade is the trade you never take. Professional traders understand this. They don't measure success by activity. They measure success by quality. Retail traders often confuse movement with progress. They believe placing more trades means creating more opportunities. Professionals know the opposite is often true. Sometimes patience is the most profitable position in the market. And here's something even more important. Discipline creates confidence, not the other way around. Most people wait until they feel confident before following their rules. Professionals follow their rules until confidence naturally develops. That's a huge difference. Confidence built on winning disappears after a losing streak, but confidence built on discipline survives every market condition. Because it isn't connected to outcomes, it's connected to behavior. That's why discipline is one of the few things the market can never take away from you. The market can take your money, it can humble your predictions, it can invalidate your analysis. But it cannot stop you from following your process. That choice always belongs to you. And the traders who understand this eventually realize something extraordinary. Their greatest edge isn't intelligence, it isn't experience, it isn't prediction. Their greatest edge is becoming the same disciplined person every single trading day. Once that happens, consistency stops feeling impossible, it becomes inevitable. But here's where the story takes another unexpected turn. Even disciplined traders sometimes destroy months of progress, not because they break their rules, but because they unknowingly carry an invisible emotional weight into every new trading day. Most traders never notice it, yet it silently controls almost every decision they make. And once you recognize it, you'll understand why some people can never truly move forward. That's exactly what we'll uncover in Lesson 7. Let's move on to Lesson 7. This lesson is short, but it has the power to completely transform your trading. Here's the truth. The market gives you a new opportunity every day. Your mind doesn't. Most traders wake up and open their charts, but they don't come with a fresh mind. They bring yesterday's emotions with them. If they made a big profit yesterday, they become overconfident today. If they took a painful loss, they become fearful today. In both cases, they're no longer trading today's market. They're trading yesterday's emotions. Professional traders understand one powerful principle. Every trading day is a new beginning. Yesterday's win doesn't increase today's probability. Yesterday's loss doesn't reduce it either. The market doesn't remember what happened to you yesterday, so why should you? That's why the best traders have a simple habit. Before placing a new trade, they mentally let go of the previous one. No excitement, no regret, no revenge. Just a fresh decision based on today's setup. Because the moment you carry emotional baggage into a new trade, you're no longer following the market, you're following your memories, and memories don't make money. Discipline does. This is one of the quiet habits that separates professionals from amateurs. Professionals don't trade to recover yesterday, they trade to execute today. And that small difference creates extraordinary results over time. But here's the final twist. If you've understood all 7 lessons so far, you might think you've finally mastered trading psychology. Yet there's one final truth that ties everything together. A truth so powerful that once you understand it, you'll never look at the market or yourself the same way again. And that's exactly where we'll end this journey in the final lesson. We've reached the final lesson, and this is the lesson that connects everything we've learned. For years, most traders believe they're fighting the market. They blame the news, they blame market makers, they blame volatility, they blame bad luck. But Mark Douglas wanted traders to realize something much deeper. The market was never your biggest opponent, your own mind was. The market simply moves. It has no emotions, no opinions, no intention to reward you or punish you. Every emotional reaction comes from within you. That's why 2 traders can see the exact same chart and make completely different decisions. The difference isn't the market, the difference is their mindset. The moment you stop trying to control the market and start controlling yourself, everything begins to change. You stop chasing perfect trades. You stop fearing losses. You stop needing to be right. Instead, you trust your process, you manage your risk, and you let probabilities work over time. That's what separates professionals from amateurs. Not better predictions, not secret indicators, not magical strategies, a better mindset. Because at the end of the day, successful trading isn't about predicting the future, it's about managing yourself in an uncertain future, and that's the greatest lesson of all. So the next time you sit in front of your charts, don't ask, what will the market do today? Ask yourself, can I follow my plan today no matter what the market does? Because the trader who masters himself will eventually master the game, and that's exactly what Trading in the Zone was trying to teach all along. Before we begin, if you enjoy this video, hit the like button, subscribe for more trading psychology content, and share this video with a fellow trader. Now let's jump straight into Lesson 1,